Welcome to Mad Money. Welcome to Cramerica. Good morning, friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, explain how we get bottoms like today. Call me 1-800-743-CNBC. Tweet me, Jim Cramer. Sometimes it is so darn ugly that you have no choice but to view the weakness as a buying opportunity. This morning, the futures created some serious ugliness, but the individual stocks in the index wouldn't comply. Why? Because, well, we have a lot of stocks of companies that aren't making money, and, I don't like them. We also have enough solvent, strong companies with stocks that would be getting killed this week. So today felt like a little counter-trend move, with the real economy-focused Dow Jones Industrial Average tumbling 310 points, while the more diversified S&P 500 dipped 0.05%, and the tech-laden Nasdaq actually gained 0.13%. But look, it was a very complicated day because it really did feel like a bottom, and yet I know that could be chimerical. But how about next week? Look, the next leg of this market comes down to the Federal Reserve and a few very important quarters. I think both could be tailwinds after this week's vicious shakeout. Let's tackle the Fed first because, well, they meet in less than a month on December 9th and 10th. And in the lead up to that meeting, we're going to hear from a ton of Fed officials, and there'll be a big guessing game that I can't stand. So I'm going to solve that for you right now. For example, on Monday, John Williams speaks. He's the president of the influential New York Fed, and bulls need him to talk about how either inflation's peaked or more likely how unemployment has gotten worse. After this week's declines, if we get some dovish commentary, I think people will begin to creep out of their foxholes, do some buying. Williams will be incredibly important because he also speaks on Wednesday, and he speaks Friday. This guy's got a lot to say, I guess. Beyond the Fed, we got the first of some very big earnings reports on Tuesday morning when we get Home Depot. Now, this morning, Stifel downgraded the stock from buy to hold, noting that their business could be exceptionally weak, not just because of lack of housing turnover, but also because ICE keeps targeting the day laborers who hang out at Home Depot parking lots. Of course, anything connected to housing is joined at the hip with interest rates, so the stock's a buy if you believe the Fed will cut rates next month, as I do. I have liked the despot for years and years because it's a growth cycle. In my book, How to Make Money in Any Market, I stress that growth stocks are the only truly safe stocks, and I'm going to include Home Depot because as long as housing prices have gone higher, which they sure have, you're going to see some growth from that trend for many, many years. Wednesday and Thursday are chock-filled with retail earnings. Wednesday morning starts with TJX, the parent of TJ Maxx and Marshalls, which we own for the Charitable Trust. I was cautious last quarter, too, because TJX is usually very conservative, but business was just so good. They let loose with some tremendous numbers. This is a fabulous company. So if the stock gets hit, which it often does, even on good results, picks them up. We also get, this is much tougher, the earnings from Target under the tutelage of outgoing CEO Brian Cornell. Now, I want to hear a plan that can get Target's mojo back. Mojo being a technical term meaning it's got to start doing better. Remember, this used to be a very popular chain, especially with young people, but Target struggled with price in this environment of persistent inflation. Even with its extra special private label goods, there's a price gap with Walmart, and that has to be solved. Now, Lowe's follows Home Depot on Retail Weekend. Lately, Lowe's has been in better shape. CEO Marvin Ellison runs stores that are equally attractive to the consumer and to the professional contractors. That combination's been working better than Home Depot's more contractor-focused approach. Williams-Sonoma, talk about a real wild trader. They report in the morning, and this one's going to be hard to game. I think CEO Laura Albert does an amazing job. By the way, she has fully embraced Salesforce's agentic game plan. I want to hear how that's working out. I heard her speaking at Salesforce's Dreamforce. And I want to know, because we own Salesforce for the Charitable Trust, I just can't figure out why the stock won't rally. Wednesday night's the big night of the week, the biggest night, because Nvidia reports. Nvidia is at the heart of the data center because the chips power accelerated computing and artificial intelligence. Besides hearing how the company's doing, we need to hear about the next iteration of chips, the Vera Rubin, and whether it's ready and whether it'll be a seamless transition. That will keep the company well ahead of AMD, by the way, who still is their chief rival. No, I don't expect anything from China. I think that's a dead issue now. If Nvidia is strong, I think it can ignite not a bounce, but a true rally itself. I continue to say own Nvidia, don't trade it, and that's our position for the Charitable Trust. I can't stress enough how important Nvidia is to this market because there's no AI revolution without Nvidia. But with it, we could still have a multi-year move, something that an old friend of the show told me. Dave Cote, now the chairman of Vertiv, which is key to keeping these red-hot data centers cool. They own the best air conditioning company. Now, I think Cote's appearance on Squawk on the Street this morning actually catalyzed the bull market because it was so darn bullish, and Cote is as rigorous as a business person I've ever met. I could see things turn around. That's why you got to watch Squawk on the Street. Give me a break. You got a good number from Nvidia and a big boost from the forecast. Next thing you know, the other 6 members of the Mag 7, they're going to start roaring.
That was easy.
Next up, we hear about Palo Alto Networks. Now, that's a cybersecurity company run by Nikesh Arora. And given the endless hacks lately from the Chinese using really sophisticated equipment, I think there's plenty of business for these guys. Now, we got some jarring news this morning. Really jarring for me. I don't know why I took it so personally. The retirement of Doug McMillon, the longtime CEO of Walmart. And he's going to be replaced by a fellow by the name of John Furner, who's the head of Walmart's U.S. business. Now, I had a special relationship with Doug, which included multiple trips with my 2 daughters to shop there, and I always told him about it. Doug has a remarkable interest in fighting inflation, especially high food prices. He's done real service to his customers. I think he's an American hero. I think he will be missed. He's quite a gentleman. I expect a great quarter, though, because I can't imagine Doug's last quarter being anything other than a great one. We had the Gap one when they last reported, and I was adamant that the quarter was good, yet the stock got crushed. That was wrong. The stock's been bid up nicely ever since then. Perhaps that same pattern continues. We hear from another retailer, too, that is loved by the market, Ross Stores. This one's a discounter. I don't know if its stock can keep running. I'd be a little careful. Now, Intuit reports, I don't know if you remember, we had Intuit on a couple weeks last week, and they recently sampled their new individual financial software. I thought it was swell. But I'm sure that many people haven't used it yet, and I think they'll embrace it once they try. Plus, the IRS is phasing out their homegrown competition to TurboTax. Remember that? Also on Thursday, we get the long-delayed September jobs report. Yeah, get the jobs report. September's pretty far in the rearview mirror at this point, but we desperately need any economic data we can get. Finally, on Friday, we hear from another club, this time BJ's Wholesale Club. I use this one as a barometer for Costco, that down-and-out warehouse club that I think is so great. But so far, I've been wrong of late, right for very many years, though. Here's the bottom line. The year of magical investing may indeed be over. But there are plenty of companies making big profits that I think will continue to do so. Sell-offs like this can be bought, but only if you have cash and you upgrade out of the morass of ultra-high-risk speculative stocks that are losing fortunes. Those may not make it through 2026. How about we go to Kyle, North Dakota? Kyle.
Yeah, Mr. Cramer, long-time listener, second-time caller. How you doing?
Excellent. I am doing well. Thank you, Kyle. What's going on?
So I'm calling for my 91-year-old grandmother. She's got a trust leaving to her 4 daughters. One of the largest positions is Deckers. They've been hit pretty hard since January. They've come down 2/3, trade wars, tariffs, doing their things. Is there a way for them to climb back, or should she take the profits that she still has and go for something with a little more comfortable 3/4
I wanted her to take at least half the profits. That quarter's bad. And I'm beginning to wonder what the heck is going on there. And the stock's down 60%. Otherwise, if it went down this much, I'd tell you to sell it all. I have to believe it can bounce. But holy cow, that wasn't just a bad quarter. And the last 2 quarters have been bad. So anyway, but good luck to your mom. How about Neil in New York? Neil.
How are you, Jim? It's Neil from Long Island.
All right, buddy. What's going on?
My question for you today is about FedEx. This company's stock price looks to be undervalued at the moment, at about $268 per share, but has shown some promise by increasing about 60 points since April. Despite this momentum,
you want to buy this stock? I'm going to cut you short here because this is so easy, Neil. This is one of my favorite stocks. I wish we owned it for the Charitable Trust. It sells at 14 times earnings. It sells 17 times earnings. The stock is going, I think, all the way back over 300. It's having a good quarter. And I mean, can I just say that Raj Subramanian turns out to be just one dynamite exec who I know is making Fred Smith proud. We miss Fred very much. All right, sell-offs like we just saw can be bought, but only if you have cash and only if you upgrade out of high-risk stocks. Mad Money tonight. This market is really struggling to understand the state of the consumer. So I'm sitting down with the CEO of a market research company that we use that's been very right, 100X, to hear what the proprietary insights are signaling. Then healthcare stock, $1,000,000,001 soared on its IPO. So is it too late to get into the $1,000,000,001? I'm going to be breaking down the story and giving you my take. And yesterday we held our monthly meeting for subscribers to the CNBC Investing Club, and we had so many darn fantastic questions. We decided to answer some of them right here, right now. So don't miss it and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.